Hi everyone. Today's topic is gonna be quite heavy, honestly. Give me a moment to adjust everything, make sure everything's fine. Okay, so hello again, everyone, and welcome to today's exclusive webinar brought to you by Vantage. Okay, so today's topic will be recession fears and market opportunities. So when I say market opportunities, I'm not saying that I'm going onto TradingView to look for setups, look for any kind of signals, okay? We're just gonna talk about how it works during a recession and what you can do when a recession hits. Okay, so yes. Again, for those who are tuning in from Zoom, as usual, for those who are here on a regular basis, you know that I will be able to talk to you guys a bit more if you're tuning in from Zoom because there's only like 20 plus of you on Zoom, whereas on the Vantage app, there's 1,000 of you tuning in. And the Vantage app chat is moving like crazy. It's constantly moving. So I'm definitely going to miss your message. Every time I scroll up to see older messages, the new message will just bring me back down to the bottom. So I'm definitely going to miss your message if you're talking to me on Vantage app. For those who are on Zoom, you're a bit luckier because I will be able to see your chat moving. Hi. Okay, so yeah, we're going to talk about recession fears and what to do during a recession, basically. Okay, so before we jump into the content, you guys know how this works. We need to go through the disclaimer. I know for those who are here regularly, you know this already. This is more for people who are new. Even if you're here regularly, you should still pay attention to this part. If you are new here, the disclaimer is basically just a reminder that everything that I share today is purely for educational purposes. It's meant to teach you concepts, frameworks, and ways of looking at the market that I personally use and I believe in. Okay, so my view is not necessarily the same view as another trader, but it is the view that has helped me become profitable. So it's not meant to be financial advice. It's not meant to be any form of investment advice. And this is definitely not some kind of signals group where I tell you guys to buy or sell, like buy here, sell here. Okay, that's definitely not going to happen. So why is this important? Because everyone has different account sizes, different risk tolerance, and different time commitments, and even different goals in trading. So some of you may want to grow your capital slowly over time, like me, or some of you are very aggressive. That's why trading is such a personal journey, and you cannot copy someone because everyone has different styles. Okay, so trading is very risky. A risk warning, trading margin, trading Forex and CFDs, especially if you are trading on margin, carries significant risk and is not suitable for all investors. So please be cautious when you are trading. Please make informed decisions. Whatever you do at the end of the day is your own responsibility. Nobody is forcing you to press the buy or sell button. Please please again take this as a learning journey and not a signals group. Okay, this is purely educational and this is not any kind of like promise for you to win. Okay, so all right, let's jump into like the introduction to your host. I do want to cover this a bit faster because then we can spend a bit more time on the Q&A session if you guys have questions. If you don't have questions, then I'll just share my experiences, I guess. Okay, before again, I need to introduce myself. So my name is Cassandra. You guys can call me Cass. A little bit more less formal. And I want to keep this like sessions a bit more friendly and interactive. So I am an investment analyst from Everest Fortune Group. Everest Fortune Group is a research firm. We focus a lot on like back testing, strategy testing, forecasting, charting. Basically, we just study the markets a lot to see where it's going. Okay, so we've been recognized globally as the finalist for the best Forex and best equity research for multiple years running. Okay, my role there involves deep market research from macroeconomics analysis to technical price action. On top of that, I am also a prop trader. For those who don't know what prop trading means, it means that I am a funded trader by different companies. To become funded, I had to pass a few tests. the test required me to do 10% in profit within a month without having a drawdown of 5%. So I've done this test like multiple times and I've passed it multiple times. 10% to me is not that hard to achieve, but I guess it's not that easy as well because the passing rate for these tests is less than 5%. Okay, actually, maybe I think it's less than 3%, maybe. Okay, so I've passed this at multiple times, and that's why today I've been invited by Vantage on behalf of Everest Fortune Group to do this webinars for you guys so that I can share my experience and share how I became profitable in trading. So, I mean, today we're going to talk about recession. So even in a recession, you will be able to be profitable in trading. It doesn't matter. People are making money every single day, whether the market is good or bad, whether there's a recession or not, people are still making money on a daily basis. Okay, so let's see what we have today. So our key agenda for today is understanding recession signals. And then we're gonna go on how stocks, bonds, and commodities react to recession, defensive plays, and safe haven strategies. We're gonna talk about like gold, Japanese yen, CFDs, some of those things, okay? And then we're gonna talk about how to spot opportunities in economic downturn. So you can reckon by recognizing early signals of recovery or policy pivot points. And then you can use, like economic calendars and whatnot to help you time trade around news. And then once we're done with all of that, we can do a Q&A session. For those who are wondering why my voice sounds a bit wonky today and like why I feel like I'm mumbling a little bit. I am not feeling well. I caught a virus. Okay, that's because I have young children. So my daughter went to the playground and she probably caught something from the playground because it's a public area. And like I have been stuck with this sore throat and like flu for a week now, since last Thursday actually, and it's not going away. So that's why I sound a bit wonky, and I will be having a bit more water breaks so that I can bear with speaking for 1 hour. Okay, so please be patient with me. Please bear with me. I hope like whatever I share with you guys helps you become a better trader. If not, helps you become a more knowledgeable trader. Thank you for still having this webinar. Yeah, I know I could have canceled the webinars, but like I kind of feel bad for disappointing the brokers, right? So I try my best to still do it. As long as I don't lose my voice completely, I still try to do it. Okay, so all right, let's start with the basic. What exactly is a recession? So you've probably heard economists throw around the words casually. I mean, you've heard many people talk about recession casually, especially on financial news. But the simple terms of recession is that a recession happens when the overall economy starts slowing down significantly and for a sustained period of time. Okay, so most countries define it as 2 consecutive quarters of negative GDP growth, meaning the economy is shrinking, not growing. But beyond that definition, what really causes a recession is a loss of confidence. So businesses stop expanding, customers cut back on spending, and banks become more cautious about lending. So think of the economy like a heartbeat. When it's strong, money circulates quickly. People are buying, investing, hiring. But when fear creeps in, that heartbeat slows down. So consumers stop spending, companies freeze hiring, and investors pull back. That slower circulation leads to job losses, declining profits, and tighter financial conditions. That's a recession. Oh my gosh. Sorry, guys. Okay, now, a recession doesn't happen overnight. Okay, that they build up over time, often because of a mix of factors. So like inflation, high interest rates, supply shocks, and geopolitical tensions. Okay, well, technically, if it's geopolitical tension, it does happen overnight because if there's a war, that unexpected war or anything, whatever, or like unexpected tsunami or like a natural occurrence, then yeah, that's gonna happen overnight. But usually it doesn't happen overnight. Okay. So as a trader, our job isn't to predict the exact date of a recession, but to recognize the early warning signs because those signs show up on the charts long before headlines do. So the real power is in understanding what those signals look like and how to trade around them. And that's exactly what we'll cover next. Okay, so I don't know if you guys have ever watched this show. I think it's on Netflix. It's called The Big Short. The Big Short, right? Have you guys watched that show before? I'm actually Googling right now. Okay, so The Big Short is one of my favorite movies. It's about this guy, I cannot remember his name. Michael Burry, and then a few of the traders or investors. They're like this hedge fund managers who realized that the 2008 the 2008 bubble was gonna happen, the financial crisis was gonna happen before it actually happens, because they were reading tapes and they saw signs where the recession was going to happen before it happened. So they actually started to short the market before the recession happened, and they made tons of money. They made like hundreds of millions of dollars during this period. So as a trader, as an investor, if you are able to see a recession happen before it happens, then you will have a lot of advantages, because then you will be very prepared. Today's topic is not psychology of a profitable trader. Wait. Sorry, did I get it? Uh, no, today's topic is recession fears and market opportunities. Okay, scared me for a moment. I thought I was on the last wrong topic. I think psychology of a profitable trader was done weeks ago, if I'm not mistaken. Give me a moment. Yeah, I think psychology of a... So I'm on Vantage app. I don't know if you guys can see it, right? Let me see what I'm showing you guys. Yeah, I'm on Vantage app, and Vantage app says recession fears and market opportunities. Schedule published was Psychology of a Profitable Trader. Psychology of a Profitable Trader we done it, I think, a few weeks ago, if I'm not mistaken. But yes, thank you so much for highlighting. Can you just give me a minute so that I can update Vantage? Can you guys let me know where it's saying I just need to update Vantage backend team so that they know that there's a discrepancy. Let me see. In Vantage calendar, it's a different topic. Saying that in Vantage calendar, it's a different topic. Okay. I attended that a month ago. Okay, thank you so much, Alex. Thank you, Nina. Thank you, Gula. And thank you, Andy, for highlighting. Please check. Also, Wednesday topic is not. I'm gonna click into the link. Sorry, guys. A little bit of a delay. Clicking into the link to see what's happening. Thanks, Gula and Andy, for sharing. Okay, it says I can't find that page. Okay. Anyways, I've told Vantage backend team, so I think they will get it sorted. But thanks for highlighting, guys. I'm just following what is scheduled for me. So what is scheduled for me is recession fears and market opportunities. And I'm also following Vantage app. So Vantage app also says recession fears and market opportunities. By the way, psychology of a profitable trader, I think we did it like a month ago. We did it like last month. Okay, so I'm gonna continue with today's topic. Anyways, I hope you learned something from today's topic. Okay, okay, thank you so much. Okay, so I'm gonna continue. So let's talk about the three most reliable signals traders and economists watch to identify when a recession might be on the way. Okay, so first is the yield curve inversion. This might sound very technical, but I'll simplify it. The yield curve is just a graph showing interest rates on government bonds. Okay, I didn't show an example here. Instead, the example I chose to show is the unemployment rate because I think that's easier to understand. Okay, so short term versus long term. Normally, on long term bonds pay more because investors are taking on more risk. But when investors expect the economy to slow down, they start buying long-term bonds for safety. This demand pushes long-term yields down below short-term ones, and that's called a yield curve inversion. Okay, so I wrote this here in case you guys cannot make up what I'm saying because I do feel like I'm mumbling a lot because of my sore throat. Okay, anyways, historically, every major US recession since 1950s has been preceded by an inverted yield curve. It's basically the bond market's way of saying wrong, something wrong is going to happen soon. Okay, that's basically a signal, a warning from the bond market. Okay, secondly is the unemployment rate, which I put an example here. So employment data is like the pulse of the economy. When companies stop hiring or start laying off workers, consumer spending falls. And since 70% of GDP is driven by consumption, that's a huge hit. So rising jobless claims often show up months before GDP turns negative. So if you see people losing their jobs, if you hear, if something happens, you will start to see unemployment rates rise higher. That's a flashing yellow light for recession risk. Third will be GDP. Gross domestic product measures the total value of goods and services produced. Falling GDP confirms the slowdown, but remember, GDP is a lagging indicator. It tells you the economy is already slowing, not that it will slow. That's why traders look ahead using data like PMI, retail sales, and consumer confidence to anticipate the turn before it's official. So these three, which is the yield curve inversion, rising unemployment, and falling GDP, these are your recession dashboard. So as traders, the earlier we recognize these shifts, the earlier we can position for the next move. So I say, no worries. Sorry, registered for psychology of a profitable traders. No worries. Okay, for those who registered for psychology of a profitable trader but got recession as your topic, feel free to leave. I already covered that a month ago, so there should be a recording. You can email Vantage to ask them for the recording of a psychology of a profitable trader. For me, I have been asked by Vantage, like moving forward, when I take you guys on Tuesdays to talk more about the economy. So I won't be talking so much on like trading psychology or like technical analysis anymore. For me, it's gonna be a lot about the economy, a lot about um fundamental analysis about news about what's happening in the world. Okay, so I hope you guys understand, and for those who sign up for psychology of a profitable trader, I'll see you guys next time if you want to join my webinar. Okay, yeah. So I'll just let Vantage know. Just let Vantage know that there was the mix-up is, yeah. Okay, so let's move on. Okay, so risk on, risk on, risk off, how traders read sentiment. So now let's connect all this back to trading psychology. Okay, I know today is not psychology of a profitable trader, but it is linked to trading psychology and how the markets react. So every day, global markets shift between two emotional states, risk on and risk off. Okay, when investors feel confident, like during strong economic growth, they take risk, they buy stocks, they invest in emerging markets, okay, trade riskier currencies like the AUD, the GBP, and the NZD, okay? That's a risk on environment. But when fears set in, whether from recession risk, war, or policy uncertainty, investors move their money to safety. So that's risk off. They put their money into safe haven assets like the US dollar, the Japanese yen, the gold, or even US Treasury bonds. This shift in sentiment can create huge trading opportunities. And this is where platforms like whatever platforms you're using come in, okay? Because through these platforms, traders can access multiple asset classes, okay? Platforms like Vantage, you can access Forex, indices, commodities, and trade both sides of the market. So when fear rises, traders can long gold and short risk currencies. When optimism returns, they can flip and write indices like S&P 500 or DAX. Okay, so instead of being scared of recession, traders can learn to navigate between them. Recessions are not the end of opportunities. They're simply the start of new cycle, and structure always returns after chaos. Do you guys notice that there's always going to be a transfer of wealth? Every time there is a recession, instead of fearing, okay, if you are a savvy investor, instead of fearing, instead of being like, oh my God, recession is coming, I might lose my job, yada yada yada, people are going to lose their jobs, businesses are going to go down, yada, yada. You should put it in a very positive view, as in recession is coming means opportunity is coming. Things are going to be very discounted soon. Things that used to be, let's say Tesla was, I think Tesla is $300 or $3,000. Let me check the price of Tesla. Sorry, this is only going to take 10 seconds. Okay, so, oh my gosh, Tesla is $453. That is crazy. I got in at Tesla at $300, by the way. Okay, I did not. By the way, I buy stocks and I leave it and I don't look at it anymore. Oh my gosh, that is crazy. I didn't know I made so much from Tesla. But anyways, I bought Tesla when the market was down. This is why when the markets are down, instead of panicking, you should be happy because now things are going to be very discounted. So I got in at Tesla at $300 in July. I got in at $300 in July, and today is $453, which is surprising to me because I haven't been checking my stocks. So anyways, this is why when a recession happens or things are falling, you shouldn't be panicking. Instead, you should be ready to get in for a buy. That being said, when the markets are good, you should not be spending your money. You should be saving your money to get ready to buy when there's a discount. Okay, that's for me at least. I don't know about you guys. I know people who are like, oh, they're making so much money and then they go and buy like branded bags, branded watches. I mean, watches is okay because there's value in watches. Branded bags, branded whatever, go on holidays, do this, do that, do this. Do you know, if you know me personally in real life, I'm actually very thrifty because I always tell people, oh, I'm broke. I'm constantly broke because I'm broke in a sense where my money is actually not being spent on like holidays or okay, to be fair, I still go on a lot of holidays, but I could be going on way more holidays. I could be flying on business class way more, but I still try to keep my lifestyle very low because I want to save money for during the times where the discounts are coming when the discounts are coming so that I have money to buy the discounts. So this is why in July I had extra money lying around in July. That's why I put all my money in Tesla and I bought it at $300. And today, which I did not expect to check the stocks today, I just wanted to give you guys an example. Today, Tesla stocks is $453. I put about $100,000, by the way. I made 50%. That's so crazy. I made 50% from Tesla since in 3 months. And that's because the market was bad in July when I got in. Yeah, I'm gonna check my stocks after this webinar ends. Okay, so this is why when the markets are good, you can spend. I'm not saying just live like a hermit, don't leave your house. You can spend. It's just that spend sparingly, save money so that when the recession comes and things become very discounted, buy. Buy, okay, buy. Okay, so how stocks, bonds, and commodities react to reaction. Even though I'm feeling very sick, I'm now suddenly feeling very lively because I now know that I made 50% from Tesla. Okay, so when recession fears rise, one of the first markets to react is Forex. So it reacts fast. Currencies tell you that the heartbeat of global confidence. Give me a moment. I just need to update, I need to update Vantage again. Okay, there you go, sorry. And reacts fast. Currencies tell you that the heartbeat of global confidence. Every currency reflects not just its economy, but also how investors feel about risk. And during recession, that risk appetite changes dramatically. Let's start with the safe haven currency, the US dollar, the Japanese yen, and Swiss franc. Okay, these are currencies investors run to when fear dominates the market. Why? Okay, these are the currencies that are considered safe haven. They have, because their economies are considered stable, liquid, and trusted. So the US dollars, for instance, remains the world's reserve currency. When there's uncertainty, global institutions prefer holding US dollars because it's the safest and most widely accepted in the world. During times like the 2008 global financial crisis or the early 2020 COVID crash, the yen and the franc also strengthened. The logic is simple. Investors unwind risky positions and spark their capital somewhere safe. Then we have the risk currencies like the Australian dollars, the British pound, and the New Zealand dollars. And I guess you can consider the Canadian dollars as well. This currency depends heavily on global trade and commodity demand. When the world slows down, exports fall and their economies take a hit, and these currencies usually weaken. Why? I'll give you an example. So Canadian dollars is very linked, is very tied to the prices of oil. Why? Because Canada is a huge producer of oil, right? I don't know I think they're like number 3 in the world, if I'm not mistaken. I don't know what are they, but okay, I'll give you another example. Brunei, for example. Brunei is a country that everyone knows is a very big producer of oil. Okay, so let's say the world is in recession. That means export will fall, people will want less oil, or the prices of oil, the demand of oil, because they cannot even afford food. How can they afford oil, right? That's just an example. So when oil prices drop, usually Canadian dollars will drop as well because Canadian dollars is very linked or very tied to the prices of oil. Similarly to Australian dollars, Australian dollars is very tied to, they're a very big producer of one commodity. I cannot remember it right now. If you guys if you guys know it, let me know in the chat box. But Australian dollars is also very tied to one of the commodity. I just cannot remember it right now. And when the price of that commodity falls, usually the price of the Australian dollars fall. That's why these are considered risk assets, because these assets are tied to commodities rather than like how strong the value is on a normal basis. So for traders, it creates massive opportunities. When risk sentiment turns negative, setups like AUD USD, GBP JPY shorts, and long on USD JPY can align beautifully with global flows. And when the market recovers, you can flip because those risk currencies often lead the rebound. So remember this, in Forex, recessions aren't sometimes something to fear. They're a shift in flow. Your job as a trader is to follow where that money is moving. Okay, so now let's talk about commodities, the backbone of global economy, starting with gold. The classic safe haven and the one that everyone runs to is gold. Okay, so when fear spikes, trader buys gold. Why? Because gold holds value when confidence in paper assets fall. It's not tied to corporate earnings or interest payments. It's pure perceived value. During recessions, you often see gold prices rally because investors move away from risk assets like equity and into something tangible. But gold isn't just about fears, it's about an inflation hedge. If central banks print more money to fight a slowdown, inflation expectations rise and gold tends to follow. Let's talk about oil. Okay, so oil tells you a story of global demand. When economy slows, factories cut production, people travel less, and businesses reduce energy use, all of which lower oil demand. Prices often fall sharply, especially early in a recession, and therefore Canadian dollars and currencies tied to oil will also drop. Canadian dollars, I would say the Brunei dollar, but then Brunei dollar is also pegged to the Singapore dollar, so not really. Okay, so then there are also industrial metals like copper and silver. Okay, copper. Okay, yes, I remember now. Australian dollars is actually linked to copper and silver, if I'm not mistaken. Okay, copper is nicknamed the doctor of economy because it's used everywhere: construction, electronics, manufacturing. If copper is falling, it's usually because growth is slowing. As a trader, you can use these instruments to express your view of the global cycle. Gold for safety, oil for growth trends, and copper to gauge recovery strengths. The trick is to see which phase the economy is entering and align your commodity positions accordingly. Okay, so now let's talk about stocks and indices, which are usually where recession are felt the most. When headlines start talking about slowing growth and layoffs, investors panic and start selling equities, but not all stocks fall the same. Some sectors actually hold up better and even outperform when the economy contracts. We call these defensive sectors like healthcare, utilities, and consumer staples. People still need medicine, electricity, and groceries no matter what's happening in the economy. Okay, that's why these sectors tend to be more stable. On the other hand, cyclical sectors like technology, banking, retail, and energy are more sensitive to economy changes. When spending slows, the earnings get hit harder. So as a trader, you can trade CFDs, a major indices like S&P 500, NASDAQ, FTSE 100 or DAX, all of which react differently during recessions. So the S&P 500 often drops first, but tends to recover earliest as markets anticipate stimulus. The Nasdaq, which is heavy in tech, can be volatile. It falls hard but rebounds aggressively when optimism returns. The FTSE and DAX are influenced by commodities and export demands, so they follow global trade sentiment closely. This is where technicals and fundamentals merge beautifully. By understanding which sectors move, not just how, you can position smarter, whether that means holding the index during panic or buying it during an early stage of recovery. The key takeaway is a recession doesn't kill opportunity, it disburses it. The money that leaves risk assets simply finds its way to safety. The traders who can follow that flow are the ones that win. why did you get in on Tesla? Okay, out of the topic, someone is asking why I got into Tesla. So when I got into Tesla, I think that was when Elon Musk tweeted that Trump was on the Epstein files, and then Trump actually said something, and then people were like selling Tesla, and the stock of Tesla was dropping like crazy. Okay, see, the thing is, when that's happening, I know people will be panic selling, right? I know for a fact people will be panic selling because they're afraid. What if Tesla um goes out of business? What if Tesla goes bankrupt? What if blah blah blah? So they get out of Tesla. But I know I follow Tesla. Okay, I don't follow Tesla very closely, but I do follow some companies very closely. Do you guys know that Tesla is a company that is coming up with that robot, that AI robot? I think it's $100,000, right? We need to agree that AI is the future, right? So how can Tesla go bankrupt if AI is the future? So Tesla is also heavily invested in AI. Tesla is building those bots, with those, like those AI bots where they can like clean houses, they can like do laundry, they can like they're basically like helpers. They're basically like domestic helpers or like maids or like nannies, right? That is the future of the world, and Tesla is actually building that. So even though the stock prices was dropping like crazy because the Tesla car sales was like dropping, if you read into it more, you'll know that actually Tesla is such a strong company and Elon Musk will never let it drop. That's why I got in at 300, and I was lucky at that time because I so happened to have spare cash lying around at that time. I literally had spare cash because I'm so thrifty, right? I'm so thrifty and I have spare cash, and I'm just like, okay, what do I do with my spare cash? So I'm just like looking for things to invest. I don't want to invest more on Forex because I already have funds for Forex. I don't want to invest more in property because I already have funds for property. So if you have a pie chart of your portfolio, right? Your portfolio should be like something should be Forex, something should be cryptocurrency, a certain percentage should be property, a certain percentage should be blah blah blah, a certain percentage should be blah blah. So I had extra spare cash, and I'm just like, okay, maybe I should put it into stocks because I don't have a lot of stocks in my in my portfolio, and that's why I got into Tesla at that time. So it was really good timing, and it's also because I spent time reading about Tesla. Okay, so let's go into the next thing, which is this defensive plays, gold, healthcare, utilities, and JPY. When the economy starts showing signs of weakness and when the headlines get scary, like we're hearing about inflation, job losses, and geopolitical tension, investors immediately shift their mindsets from how much can I make to how much can I keep, right? Right? That's true, right? Because when you are in the recession, you are so scared of losing things. You're like, okay, how much can I keep? I need to be safe. I need to like be thrifty. No, that's the wrong mindset. I can tell you now, as someone who has made a lot of money from the markets, let me tell you now, when the market is booming, that's the time when you should be saving money and be cautious and just be more careful. When there is a recession, that is the time you keep buying everything that is discounted. Everything is gonna be so discounted. All these stocks that used to be $3,000 is now gonna be $1,000, okay? Okay, that's why we call defensive plays strategies and assets designed to protect capital first and profit second. Now, defensive doesn't mean boring, it simply means being strategic. Instead of chasing high risk, high volatility assets, traders and investors looked for instruments that historically hold value when everything else is falling apart. For example, in the equity world, you often hear about defensive sectors like healthcare, because people need medicine and treatment regardless of the economy. It doesn't matter if the recession is happening. It doesn't matter if the economy is slowing down. People are still going to fall sick no matter what. We still need medication no matter what. Okay, the next one is utilities. Electricity, water, energy. You cannot stop people from paying their bills even in a recession. It doesn't matter, even if we're having war, even if we're having whatever it is, things that will never, ever, ever slow down is healthcare. People are gonna fall sick no matter what. Utilities, I'm gonna need water, I'm gonna need electricity no matter what. And consumer staples, everyday items like food, toothpaste, soap, groceries, rice, meat. Okay, these are always going to be in demand. So as a trader, we're not limited to just buying stocks. We can access a wide range of CFDs on Forex, gold, oil, and indices, meaning we can take advantage of both rising and falling markets. This is where the concept of safe haven assets come in, and that's what we're going to explore next. Okay, so when the world panics, money doesn't disappear, it moves. Okay, when recession happen, money doesn't disappear. It is just a transfer of wealth. When there's a recession, the rich don't suddenly become poor. It's just that the money will transfer into someone's hand. And you better be ready, because if you are ready, you are going to be the receiving end of that transfer of wealth. So it flows out of risky assets like tech stocks, crypto, and emerging markets and flow into what we call safe haven assets, instruments that investors trust to preserve value during uncertainty. Let's go through the most important ones. The US dollars. Okay, so the US dollar is still the world's reserve currency. It's used on the global trade, commodities, and financial settlements. In times of crisis, everyone wants liquidity, and nothing is more liquid than the dollar. Okay, during the 2008 global financial crisis, while stocks crashed, okay, the US dollars actually rallied. Traders, okay, who were long US dollar pairs like the USD, JPY, or short EUR USD would have benefited from that risk of move. Okay, the next will be the Japanese yen. The yen is often considered as the classic safe haven. Japan is a very low interest rate and huge foreign investments. When fear rises, Japanese investors pull money back home. Okay, so I'll give you an example. When things are looking good, the Japanese are so smart. They take their money, they take the Japanese yen, and they go and buy foreign things. They buy like US homes, they buy like US businesses, they invest in like overseas stuff, okay? This strengthens the yen, okay? But then when a recession happens, they sell everything overseas. They sell those homes that they bought. They sell everything that they bought foreign, and they bring the money back into Japan, okay? So that's why the Japanese yen tends to strengthen during global panic, because because the Japanese are just so disciplined and they're so smart, and they know how to strategically do this. When things are looking good, they go and buy things outside. When things are looking bad, they resell everything and they bring their money back home. Okay, so the next will be the Swiss franc. Switzerland is neutral, financially stable, and known for strong banking regulation. The CHF often strengthens during political tension and war-related uncertainty. The next will be gold. Gold is the ultimate safe haven asset. It's been trusted for thousands of years. Unlike currencies, gold can't be printed. During inflation, war, or recession, gold tends to rise because people move out of paper assets into hard assets. In 2020, the COVID hit, gold soared to over 2,000 per ounce as global confidence collapsed. And I think gold is also at an all-time high today. I don't know what's the gold prices right now, but I know it's just rallying like crazy. Okay, so that means that people are putting their money in safe haven assets at this current point of time. The next will be US Treasury bonds. Okay, bonds are less popular among retail traders, but they're important. When investors buy bonds, yields drop. Falling yields are one of the most reliable signs of flight to safety. Okay, so each safe haven behaves slightly different depending on the type of crisis. If the financial crisis, USD and JPY usually dominates. If it's an inflationary crisis, gold tends to lead. If it's a geopolitical crisis, CHF and gold often shines. And there's also one that is not very popular, but I think it's up and coming. It's actually the Singapore dollars. Okay, I am also very biased towards that currency because I am based in Singapore. I live in Singapore. I've been here for 10 years. Okay, so my kids hold Singapore passport. So I am I am very biased for the Singapore dollars, and it's also up and coming. So the Singapore dollars is actually also slowly becoming a safe haven assets, or at least it's being recognized as having safe haven asset properties. Okay. That's why recently I had a choice to keep my money in the US dollars or the Singapore dollars. I actually chose to keep my money in the US dollars. Sorry, in Singapore dollars. So a lot of my investments are foreign as well. And I had a choice when I recently sold a US dollar asset. I had the choice to like keep it in the US dollars or convert it back to Singapore dollars. And I chose to convert it back to Singapore dollars because I have so much faith in Singapore dollars compared to like whatever is happening in the world right now. Okay, so now that we know that the safe haven assets are, let's talk about how to actually trade defensively, how to turn this knowledge into a plan. Okay, the first rule is correlation matters. Okay, I've put an example here, which is the gold and US 500, which is S&P. Okay, so the first rule, when fear rises, you'll notice a pattern. Gold usually goes up. So if you guys go and look at the gold chart today, you know that gold is at an all-time high today, right now. I know this because I just did an analysis yesterday on gold. Okay, and I know it was like it just keeps soaring. So it is a sign that there is fear in the market. That's why people are putting their money in safe haven assets. So indices like S&P 500 and Nasdaq will fall during this time. JPY pairs like USD JPY tends to drop because yen strengthens. So even without reading the news, the market's behavior will tell you the emotional tone that is happening in the market at this current point in time, whether traders are risk on or risk off. So for example, imagine you're watching the market during a period of bad economic data. Maybe unemployment numbers come out worse than expected, or a major bank reports losses. You start to see US dollar strengthening, gold pushing higher, and equities dropping. That's your cue. Sentiment is risk off, and you can position accordingly. So how to trade on Vantage, actually? You can buy gold CFDs when volatility rises. You can short indices like Nasdaq and S&P when global fears rise, and you can buy safe haven currencies like the US dollars or the Japanese yen against weaker risk currencies like the Australian dollars or the GBP and the NZD. Okay, you don't even need to predict, you just react to the flow. So the second rule is to hedge intelligently. If you have open trades in risky assets, say long positions in indices, okay, you can balance that risk by holding a smaller long in gold or USD JPY. Anyways, gold tends to just go up in prices overall. So holding it long term shouldn't be a bad thing. Okay. So how traders can spot opportunities in downturn when headlines scream recession, market crash, or economic slowdown, most people will panic. People like me, I am excited because then I know everything is going on a discount. Okay, but I know majority people are panicking. They're just like saving. They're just like, no, I am so happy. It's so bad to say it, but when a recession happens, I know a lot of people are suffering, but to an investor, they are so happy. They're like, yay, the discount has finally arrived. It's time to buy. Okay, so they rush to close their accounts, stop trading, and stay away from the markets. And here's the truth that every professional trader knows. Volatility is not your enemy. Uncertainty is where opportunity lies. When markets move violently, liquidity increases and price movements become more predictable because fear exaggerates behavior. Traders who understand why people are panicking can position themselves before the rebound happens. Let's think about what happens in a downturn. Stock sells off aggressively, but not all companies are in trouble. Currencies fluctuate wildly, but safe havens strengthen. Commodities may drop sharply at first, but eventually stabilize when supply adjusts. The smart money institution, hedge funds, and prop firms, they are panicking. They're not panicking. They're waiting. They're waiting for the right time to get in. They're building their positions quietly, buying at discount while the rest of the world is emotional. So as a trader, your mindset should shift from fear to preparation. Ask yourself, what is the market overreacting to? What asset is undervalued now because of this temporary panic? Temporary panic is the best time to invest. You don't have to catch the bottom. You just have to recognize when fear is overdone, and that's where great trades begin. Okay. Okay, so let's talk about how to identify opportunities, not just in theory, but in practical tradable terms. There are three main cues to look for when the market is crashing. Sentiment extremes. Okay, when everyone becomes overly bearish, when social media analysts, even news anchors are saying this is the end, then that's often near the bottom. Okay. There's this joke that my friends and I used to say. If the layman comes and tell you, okay, like if today my dad, who's someone who is not a very savvy investor, if today he comes and asks me, hey, have you heard of cryptocurrency? That's when I know cryptocurrency is already at the peak, because even people like my dad has heard of it, right? So if you hear people on social media, analysts or even news anchors say that, oh my God, the market is we're in the doom, where it's the end, we're at the market is going to hell, then you know that we are reaching the end of recession. Because even I don't want to say the word, okay, the people who are not savvy, if the people who are not savvy are informed, that means we're reaching the bottom already. So you can use tools like the Fear and Greed Index, the COT, which is the commitment of traders data, or even price behavior itself, like massive daily candles followed by doji candles to see whether panic is fading. So the next will be accumulation patterns. This is where market structure and the Wyckoff method, I don't know if I taught you guys the Wyckoff method before, comes back into play. After a huge sell-off, price doesn't instantly reverse. It starts to move sideways. So building a base through accumulation, smart money enters quietly, volume increases gradually, and you'll start to see higher lows forming. And that's the footprint of big players positioning early. The last will be fundamental and technical alignment. The best opportunities happen when the macro narrative and the chart agrees. For example, if inflation is easing and central bank hints at rate cuts, that's a bullish for equities and gold. If GDP is weak but inflation remains high, that's a setup for buying gold and shorting risk currencies like AUD and GBP. If oil prices collapse due to oversupply, but OPEC announces cuts, that's a buying opportunity on crude. So the key is to wait for confirmation, not prediction. Let the chart show you the worst might be over, and then align your trade idea with the fundamental narrative. Okay, we're down to our last slide, and then I'm gonna have to add, I'm gonna have to end, we don't have time for Q&A anymore. So now let's turn the insights into actionable trades. Okay, so the first principle is to scale in, don't dive in. When you spot a market that looks oversold, don't go all in immediately. Instead, buy your position gradually. For instance, if gold dropped from 2004 to 2000, and you believe it's stabilizing, enter small first, add to your position only as price confirms your directions. The second principle is to diversify your approach. I am all for diversifying. If people ask me, oh, what should I trade now? You should trade on the short term, maybe Forex. On the long term, maybe property, maybe index, okay? I'm all for diversifying. If you guys see my portfolio is actually so little in Forex. My portfolio is majority in actually property and stocks. Okay, so I still trade Forex. It's just that it's a very small percentage of my entire portfolio. Okay, so recession trading doesn't mean hiding in just one asset. You can balance your portfolio with a mix of maybe safe haven assets like gold, US dollar, then JPY, and then recovery assets like stocks, indices, or oil when demand picks up, and hedging tools available on Vantage actually like CFDs or indices, forex and commodities. And the third principle, and it's very crucial, is timing through data. It is so important to be an informed trader, informed investor. Why I got into Tesla at $300 when everyone was selling Tesla stocks is because I was informed, because I went to do my research. So if you are informed, you will have the upper hand when you are an investor or a trader. Okay, so that's all I have for you guys today. I will see you guys next week on Tuesday. Remember, for those who have been following my webinars for a long time, my webinars was always very heavy on technical analysis. So I used to teach like technical analysis, trading psychology, but I have been asked to change my topics to more on fundamental analysis and more on like news and like yeah, basically what we learned today, which is the economy. Okay, so moving forward next week, I will be touching on the economy again. So I'll see you guys next week. If you guys are interested in that topic, please sign up and I'll see you guys next week. Okay, take care, guys. Thank you for the thousands of you who joined my webinar today. Thank you, Alex. I'm just saying bye to those who are on Zoom because I can say bye to those who are on Zoom. I cannot talk to the thousands of people on the Vantage app. So thank you, Alex, Eric, Boss, Cello, Catherine, Brian, Cliff, Eula, John, Karsten, Muna, Kupia, Nina, Richard, Sam, Tessa, Lonika, Bob. I will see you guys next week. Thank you so much. Thanks, Sam. Take care. Bye. Take care. Bye.